You know the feeling. The headlines are just flashing conflict, tensions, global threats, and your gut instinct just screams, this has to be bad for the market, right? I mean, bad news anywhere must mean bad news for stocks everywhere. But what if? What if our gut is just plain wrong?
It's really the million-dollar question, isn't it? We've got this built-in assumption that any kind of geopolitical turmoil is an automatic market killer. It's a nice, simple story, but is it the real story?
Well, it turns out that when you actually dig into the data, that gut instinct can lead you way off track. The link between what's happening in the world and what's happening to your investments isn't some straight line. It's more like a tangled web. And understanding that web, well, that's the key to seeing what's really going on.
So here's what we're going to do. First, we'll talk about why a single risk score is kind of flawed. Then, we're going to unpack what risk actually means by breaking it down. We'll look at the surprising difference between threats and actions, see why all these little details matter so much, and finally, we'll put together a whole new playbook for how to think about the headlines. All right, let's jump right in with the big problem. This idea of using one single number to capture all the geopolitical tension in the world. I mean, it sounds simple, but it's kind of like trying to describe a whole symphony with just one single note. You miss everything.
I think this is a great way to look at it. A single geopolitical risk score gives you this really blurry view. You know something's happening, but all the crucial details are just lost in the fog. But by breaking it down into specific categories, you suddenly get this high-resolution picture. You can actually see the distinct shapes and movements that are driving the market. And this quote from the research really hits the nail on the head. A single composite index actually hides what's going on. It masks the mechanics because different kinds of risk can have totally opposite effects, sometimes canceling each other out in the big picture while causing huge, wild swings in specific sectors. Okay, so if one big score isn't going to cut it, what are the details we should be paying attention to? Let's unpack what researchers actually mean when they talk about the different flavors of geopolitical risk. Researchers Dario Caldera and Matteo Accaviello broke it all down into these 8 distinct categories. And notice the split here, because it's really important. On one side, you have threats of war, terror, even threats to peace. And on the other side, you have actions, like the actual start of a war or a terror act. This distinction right here, this is where things get really, really interesting. And just so we're clear, this isn't just some subjective list they came up with. The Geopolitical Risk Index, or GPR Index, is built by systematically scanning major newspapers for keywords related to these 8 categories. It's a totally data-driven way to measure the temperature of global tensions over time. All right, now we get to the heart of the findings, and this is where our everyday assumptions get totally flipped on their head. The data shows this fascinating and often super counterintuitive difference between the threat of something happening and the thing itself. To put it really simply, the fear is often worse than the bite. The anticipation, the uncertainty, that constant what-if of a potential crisis, that seems to stir up markets in ways that are completely different from what happens after the event itself. Just take terrorism, for instance. You've got this period of terror threats, which is just full of uncertainty and anxiety. And then you have the tragic reality of terror acts. You'd think both would just be awful for the market, right? But the data says something else entirely. Just look at the contrast here. It's pretty stark. During times of high terror threats, you can see from the positive column that volatility in defensive sectors like healthcare and consumer staples actually increases. But when an actual terror act occurs, volatility tends to fall. See the negative column. It's like the threat creates this massive cloud of uncertainty, but the act, as tragic as it is, resolves that uncertainty for the market, leading to a completely different reaction. And you know what? We see a really similar pattern when it comes to war. It's not necessarily the moment war is declared that has the biggest impact on market volatility. Nope. It's all the stuff that leads up to it. The buildup is often way bigger than the bang. This slide just illustrates that point perfectly. The data shows that the beginning of war has a surprisingly limited impact. But look over at the escalation of war column. Whoa. It has a much stronger, more diverse impact, right? It drives volatility way up in materials and industrials, but down in tech. The run-up to a conflict, that's what really gets markets moving. And finally, it's worth pointing out that even things that don't happen very often still have power. I'm talking about low-frequency events, things we thankfully don't see much, like serious nuclear threats or threats to major peace treaties. Even though they've been pretty rare since World War II or the Cuban Missile Crisis, you can still see spikes in the data related to tensions with places like North Korea or Iran, and those spikes contribute to volatility in certain industries.
So, okay, this is all fascinating academic stuff, but what does it actually mean for the real world? Well, it turns out this super detailed view has really practical applications for basically everyone, from investors to entire governments.
And this isn't just a theory. It has real, measurable, predictive power. You can see it right here on the chart. When you take a standard financial model, that's the first bar, and you add these detailed risk categories to it, its predictive power, its accuracy, jumps up significantly. This proves that these details actually help us better explain and maybe even forecast what the market's going to do.
So here's the bottom line. This detailed view allows for way smarter decisions across the board. Investors can adjust their portfolios to handle specific risks, not just some vague idea of geopolitical risk. Banks can manage their assets and liabilities way more effectively. And governments? They can better predict the economic impact of their own policies, everything from interest rates to international sanctions.
So let's bring this all home. What does this all mean for how we should be processing the news every day? It basically gives us a completely new playbook for understanding what risk really is.
Look, if you only remember one thing from this entire explainer, please make it this. Not all geopolitical risk is created equal. A military buildup is not the same as a terror threat, and an escalation of war is definitely not the same as the beginning of one. Each one has its own unique fingerprint on the market.
And as this chart shows pretty clearly, a few of these key categories, like war escalations and terror threats, they drive a huge chunk of the impact we see on market volatility. The headline might just say, tensions are rising, but the specific type of tension is what you really need to know to understand the financial fallout.
So, the next time one of those scary headlines catches your eye, just pause for a second. Ask yourself, what kind of risk is this really? Is it a threat or is it an act? Is it a buildup or is it a beginning? Because by learning to look past that blurry single-story view, you can start to see the high-resolution picture of what's actually moving the markets.